Welcome back. With the Federal Reserve rate hike of 75 basis points in September, the federal fund rate now is post 3.25%. The Federal Reserve has targeted the Fed fund rate to be at 4% to 4.25% at end of 2032, and likely another round of 75 basis point rate hike will hit during the November period. In Singapore, banks are targeting consumers with high interest rate deposits, and fixed rate mortgage loans once again have been readjusted by our local bank. Hi, my friend Tan now also very stressed as his bank mortgage loans from 1% 2 years back now rise to near 4%. Tan will soon not be able to eat Fu Leong Tan liao. Tan says his dream to invest in another property cannot fulfill now and asked me, how about Singapore Reits? Is it still safe to invest?
One more try. This would be my last.
I told Tan, and you all this is not a financial advice. All investment has risk. Do your own due diligence. With that, is Singapore REITs still a safe haven amid the rising interest? Which sector of REITs are more defensive in such an interest rate environment? From this chart, the Lion Philip SG REIT ETF, which have high-yielding real estate investment trust with superior quality and financial health in Singapore, is used to benchmark against the STI ETF for the 1 year period. As we can see from the chart, the SREIT ETF starts to underperform STI ETF around the start of the year in January 2022. With inflation rising, the escalated Russia-Ukraine war, and rounds of interest rate hike, we can see obvious downtrend on REITs from March onwards, particularly with each rate hike announced. The sell-off are also expectations from investors for a higher yield coming from an income-generating investment such as REITs. With bonds that are generating yield that is a 3+% and is of lower volatility, why would investors subject themselves for a 4% or 5% dividend yield REIT with higher volatility? The margin of safety is thin. REITs, which are large borrowings, will see their expenses increases as interest rate continues to rise. Hence, we may foresee REITs with weak operating cash flow may raise right issues coming these 2 to 3 quarters. So, what are the sectors in REITs that can be more resilient in such an environment? Actually, there isn't any. Just kidding. The 3 main sectors would be retail, office, and industrial. As borders are opening up across countries, people will be allowed to move around more freely. People are also returning back to work in office. There will be demand and supply for both the retail and industrial sector as more consumer services resume activities. With demand comes supplies of logistics and warehousing rental space in order to provide services. However, Singapore REITs are leveraged focused on bank borrowings, and the rising interest rate will mean a rise in the cost of borrowings. Hence, the debt ratio will also increase. Most Singapore REITs are also mandated to distribute 90% of their earnings as dividends to investors. With potential earnings that could be impacted by higher debt ratio, the dividends will also likely be lower in the coming quarters ahead. Back to the question of, is Singapore REITs still safe to invest? In the short term for the next 2 quarters, we could see more volatility ahead as the Fed battles to fight inflation. Interest rate is particularly sensitive to the REITs environment. MAS has also just announced its tightening of monetary policy, which in turn led the SIBOR and SORA to increase. Investors are expecting higher yield for REITs in a high interest rate environment. However, for long-term investors looking for income, this could present opportunities for them as share prices of REITs are being sold down. Strong REITs with good capital management, sponsor, and track record like CapitaLand and Mapletree REITs will be able to tide through the turbulent times. Do like and subscribe to my channel, and I shall see you again. Adios.